Welcome to Markets Now. I'm Michelle Rook with Alan Brugler with Brugler Marketing. We did have mixed trade in both grain and livestock futures today over in the grain complex. Wheat and corn to the plus side. And Alan, let's talk about the wheat market first. We've been on a 6-day run here. Has this been all technical, or are we putting in some warm weather premium?
You've got a little of both. You got a multi-month downtrend channel in the wheat, very clear on the Kansas City charts, on the weekly and monthly charts. We broke out of that once we got into April. And an old technical indicator is that you try and double the channel when you've got a long-running channel like that. We are getting up towards that doubling point on the Kansas City. You're getting a little overbought, but you've got some pretty good fundamental support. You've got that weather issues in eastern Ukraine and Russia. That hasn't stopped their exports yet, but it's a factor. You've got fairly tight old crop inventories for export out of the U.S. and EU. And typically when we get to the end of that production cycle, that's when the U.S. is able to be a little more competitive on shipments. And then you throw in the dryness in the southern plains and the expected heat that's coming. That drives Kansas City more than Chicago because the SRW country looks like it's going to get a fair amount of rain. But you put some short covering together with those fundamental concerns, and you get a little bit of season rally going.
So how much more upside is there, especially with what you said about the rain chances?
Well, again, the different numbers between Chicago and Kansas City, but there's still 30 to 40 cents available there. I think on the weekly and monthly charts before you hit any of the main moving averages on those. The daily charts, again, they're a little overbought, but if the fundamentals stay friendly and the shorts are still there, we'll feed on it.
So the corn market has been getting help from the rally in wheat. Do you think if wheat keeps going, can corn follow, or does it have enough of its own fundamental story to keep going?
Well, there's no question that the wheat rallies help corn. Is if your feed grains are going up, you're short both of them. You wonder if you ought to get out of both of them. And of course there's a virtuous cycle there. If you get a rally, then you get cash movement, which creates sell paper the funds can buy against. But corn does have some pretty good bullish fundamentals right now on its own. They're not they're not $6 bullish, but they are friendly. I think the big one is simply that Brazil's out of the corn export market for all intents and purposes until June. We expect their monthly shipments to be less than 2 million tons a month for April, May, and probably June. And that's 3 or 4 million tons per month available to other sellers. And the U.S. is the main source of available supply here. You'll get a little bit of competition out of Argentina as their harvest gets a little further along. But the thing with Argentina is their crop is now looking like it's 4 or 5 million tons smaller than it looked like in February due to the stunt disease issues they've had down there. So again, I think we're in a great position for the U.S. to see some 1.2 million to 1.8 million weekly export sales for quite a while here. And we are at this point still cheaper on a FOB price than Brazil. So the business ought to come here. And that creates competition for your ethanol plants and your other end users, and should be price supported. Technically, yeah, it's hard to say whether you've actually got a spring low here in place. We ran into resistance up against the moving averages and the upper Bollinger Bands, but if you can punch through there, you can certainly go up towards 460.
Gotcha. Soybean market, though, has had a more difficult time and will have getting above these chart resistance levels on the upper end of the trading range just because of the export demand being weak, or what?
That's the Achilles heel for beans. The export market, it just isn't there. You've got Brazil with almost a smaller crop, but whether it's 152 or 154 million tons, it's still a big crop. Okay, they're still going to export a lot of beans, and that volume is going to start hitting us right now. I mean, it already is. Argentina's crop is almost double what it was a year ago. Of course, that was a big drought down there a year ago, but the point is more competition. So the exports are going to struggle. And USDA had that to a degree dialed into their balance sheet already. I think the other things you got to look at on the soybean side is that simply that you are seeing more bean acres than a year ago. The soy corn ratio says you should, and the market's going to assume that those are there until weather prevents it, I guess. The bull story on beans is that you've got record crush use every month, and I think we'll see record crush for all the other months of the marketing year. We're not going to run out of beans this summer. Margins are not anywhere near as attractive as they were in 2022, early 2023, but they are still positive. The beans are there. The oil demand, for the most part, is there. Meal is kind of the issue.
Cotton market ended kind of mixed today. Old crop a little higher, new crop just a little bit lower, but the cotton market is kind of imploded here. Are we done going down yet, do you think?
We found a perfectly good place to stop. Okay. Whether that's enough to actually stop here, I don't know. We had what we call death spiral liquidation. The commercials and the funds were both buying cotton pretty aggressively January, February, because USDA was cutting the ending stocks numbers. 2.5 million bales is fairly tight for old crop projected ending stocks. But when they wanted out ahead of the May options expiration and now May deliveries, the shorts were not inclined to let them out without giving them their money back. And so you had this relentless push of liquidation with nobody willing to step in and buy it on the old crop. And we took out the lows and just barely took them out. But I do like the price action right here locally, if last few days, because we are trying to hold near those old lows when the shorts are starting to cover a little bit. I think the key question for cotton is new crop acreage, and planning intent progress to date is pretty close to the average pace. You do have the weather issues down in the southern plains that are impinging on cotton a little bit. The most disappointing thing to me is cotton was trying to buy acreage with that rally in February, beginning of March. We got a planning intentions report, which wasn't all that bearish. It was actually only showing a very modest increase in acreage when the market would appear to need more. But we sold off anyway, and that's a bearish sign when good news fails to make the market move higher. So we are around 77 cents on the December contract. The lows that we saw back in December were in the 76 area, so we're close to where the buyers were before.
Nice recovery in the cattle market here today after a washout from HPAI news. Do you think that market has absorbed most of that, or was this a function of this cash trade that we saw today, steady to higher, pulling the market back?
I think reacted to the testing requirement that was announced, where if you're going to move dairy cattle in interstate commerce, you have to test them for the influenza, because it turned out most of the herds that were getting the HPAI or the bovine equivalent were bringing in replacements from Texas or other infection areas. So it made, I think it hasn't been proven to affect beef cattle to the same degree. It hasn't been confirmed in beef cattle. It really doesn't affect the meat. So I think the market was overreacting. I attribute that to the funds not being nearly as cocky as they were a year ago. A year ago, it was pretty cut and dried. When the cattle cycle said we were shrinking numbers, beef supplies were going to continue to tighten. If and when we start the retention, then feeder supplies get even tighter, because some of the heifers that have been going to the feedlots quit going there. So the bull story is still there, but the funds got battered pretty badly with the liquidation sell-off the tail end of last year. They're trying alongside again, but they're a lot more skittish this time around. If there's any consumer demand issues, whether that's from HPAI or just the general economy and inflation, they're not as willing to stick with their long positions.
All right. Thanks as always, Ellen Brugler with Brugler Marketing. That is Markets Now.